Most people spend more time planning their vacation than planning their financial future. And that one mistake, that one habit is why most Americans work until they're 65, broke and dependent on Social Security to survive. Today that changes, because in the next 10 minutes, I'm going to give you the complete beginner's guide to investing, everything you need to know in simple, plain English, no jargon, no confusion, just the truth about how money actually grows. Let's start with the most important question. Why should you even invest? Here's why. If you save $1,000 every year and put it in a savings account at 0.1% interest, after 30 years, you'll have $30,300, barely more than what you put in. But if you invest that same $1,000 every year in the stock market at a historical 10% average return after 30 years, you'll have $180,000. That's 6 times more money. Same amount saved, completely different result. The difference is investing. But before we go any further, let me kill the biggest myth about investing. Most people think investing is only for rich people, that you need thousands of dollars to start, that it's too complicated, that it's too risky. All of that is completely wrong. Today, you can start investing with literally $1. Apps like Robinhood, Fidelity, and Vanguard let you buy fractional shares of any company in the world with just $1. The barrier to entry has never been lower in human history. So let's talk about the basics. What exactly are you investing in when you invest? There are 4 main types of investments you need to know. Type 1, stocks. When you buy stock, you are buying a tiny piece of ownership in a company. If Apple does well, your stock goes up. If Apple struggles, your stock goes down. Stocks are the highest risk investment, but also the highest reward over time. Historically, the US stock market has returned about 10% per year on average over the last 100 years. Type 2, bonds. A bond is basically a loan you give to a company or government. They pay you back with interest. Bonds are safer than stocks, but they grow slower. Most financial advisors suggest having a mix of stocks and bonds. More stocks when you're young, more bonds when you're close to retirement. Type 3, index funds. This is where beginners should start. An index fund is a basket of hundreds of stocks all in one investment. Instead of buying one company, you buy tiny pieces of 500 companies at once. The most famous is the S&P 500, which includes Apple, Microsoft, Amazon, Tesla, and 496 other companies. When you invest in the S&P 500, you're betting on the entire American economy. And historically, that bet has always paid off. Type 4, ETFs. Exchange-traded funds are very similar to index funds, but they trade on the stock market like individual stocks. They give you diversification at very low cost. Perfect for beginners. Now let's talk about the most powerful force in investing, something Albert Einstein reportedly called the 8th wonder of the world, compound interest. Here's how it works. You invest $10,000, it grows 10% in year 1, now you have $11,000. In year 2, that $11,000 grows 10%, now you have $12,100. You didn't add any money, but you earned $100 more in year 2 than year 1 because your gains are earning gains. That's compounding. And over 30 or 40 years, it becomes absolutely magical. $10,000 invested at 25 becomes $452,000 by age 65 without adding a single extra dollar. Time is the most valuable ingredient in investing. Now, here's something most beginner investors get completely wrong. They try to time the market. They wait for the perfect moment to buy. They sell when the market drops. They chase hot stocks. And almost all of them lose money doing it. Even professional fund managers, people with PhDs and billions of dollars cannot consistently beat the market. So what chance does a beginner have? Almost zero. The solution? Don't try to beat the market. Join it. Buy index funds. Hold them forever. This strategy is called passive investing, and it has beaten almost every active investor over the long term. Let's talk about risk. Every investment carries risk. The stock market goes up and down, sometimes dramatically. In 2008, the market crashed 50%. In 2020, it dropped 34% in just 35 days. But here's what most people don't understand about market crashes. Every single crash in history has been followed by a full recovery and new all-time highs. Every single one. The people who lost money in crashes were not the ones who stayed invested. They were the ones who panicked and sold at the bottom. The golden rule of investing: never sell in a panic. Time in the market always beats timing the market. Now let's talk about how to actually get started. Step 1, open a brokerage account. The best free options for beginners are Fidelity, Vanguard, and Charles Schwab. All are free to open and have no minimum balance requirements. Step 2, set up automatic contributions. Even $50 a month, even $100 a month. Automate it so you never think about it. Step 3, buy a simple S&P 500 index fund. On Fidelity, it's called FZROC Zero Fees. On Vanguard, it's called VTSAX. On Schwab, it's called SWTSX. Step 4, never look at it. Seriously. Set it up, automate it, and forget about it for 20 to 30 years. The worst thing you can do is check it every day and panic when it drops. Now let's talk about where to invest, because the account you choose matters almost as much as what you invest in. If your employer offers a 401k with matching, that is your first priority. It's free money. Never leave it on the table. After maxing your employer match, open a Roth IRA. A Roth IRA lets you invest up to $7,000 per year, and all the growth is completely tax-free forever. You pay taxes now on the money you put in, but you never pay taxes on any of the gains ever. On $100,000 that grows to $800,000, you owe zero in taxes. That is an incredible advantage. Let me also address one of the most common questions beginners ask. Should I pay off debt first or invest? Here's the simple answer. If your debt has an interest rate above 7%, pay it off first, because you cannot consistently earn more than 7% investing. But if your debt is below 7%, like a mortgage or student loan, invest at the same time, because the compound growth over time outweighs the low interest cost. Here are the 7 golden rules of investing that every beginner must know. Rule 1, start as early as possible. Time is your most powerful asset. Rule 2, invest consistently, every month, no matter what the market is doing. Rule 3, diversify. Never put all your money in one stock. Rule 4, keep costs low. Choose index funds with low expense ratios. Rule 5, never panic sell. Markets always recover. Rule 6, tax advantage every dollar. Use 401k and Roth IRA before taxable accounts. Rule 7, be patient. Wealth is built over decades, not days. Here's the final truth I want you to understand. Investing is not about getting rich quick. It's about getting rich slowly and surely. The tortoise always beats the hare in the world of investing. The people who build real wealth are not the ones who found the next hot stock. They are the ones who showed up consistently, month after month, year after year, putting money into boring index funds and letting compound interest do the impossible. You now have everything you need to start. The knowledge, the tools, the strategy. All that's left is the decision. Open that account today, invest that first dollar, because every day you wait is a day of compound growth you will never get back. Share this video with someone who has never invested before. You might just change their entire financial future. Follow FinFlip for more money secrets every week. See you in the next one.